You're listening to the Real Estate Runway podcast, powered by Quattro Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right, Real Estate Runway family, welcome to another episode of the Real Estate Runway podcast. I'm your host, Chad Sutton, and I'm joined here today with Anthony Vicino. This guy has done so much in his young career. I love it. And we're going to talk about a lot of meat that really benefits you as the investor today. So Anthony is a best-selling author, real estate investor, serial entrepreneur who is committed to helping people maximize their return on life. He is the co-founding partner of Invictus Capital, a multifamily acquisition-based firm based in Minneapolis, Minnesota, with $30 million as of this writing in assets under management. He is providing busy working professionals with the opportunity to invest better. As a host of we're going to fix that. Hold on. Guys, edit that out. I'm going to jump back to the 30 million assets under management thing. He also provides busy working professionals with the opportunity to invest better. As the host of the Multifamily Investing Made Simple podcast and the author of Passive Investing Made Simple, Anthony firmly believes investing should not be complicated, scary, overwhelming, or require a PhD. With that, Anthony, welcome to the show. How are you doing today?
I'm fantastic. Thanks for having me, Chad. It's awesome to be here.
You know, it's awesome to have someone with your background and such a repertoire of things that we can talk about here on the show. But what I'd love to do before we get into the meat and really focusing on this book, Passive Investing Made Simple, and why it will really benefit the aspiring investor. Tell us about who Anthony is. How did Anthony become who Anthony is today?
So that's a hard question, right? Like we have such deep backgrounds, all of us, in terms of like every little thing that's happened to us helps influence who we've ultimately become. But for me, if you were to go back to the beginning and say like, what was probably the most pivotal thing, is the fact that I have like really, really bad ADHD. So coming out of college, that meant that I really was not cut out for the corporate route. Like I couldn't stay focused. I had bad discipline, and I was just generally not a very hard worker when it came to working for other people. But at that point, I wasn't entrepreneurial. Like I wasn't the kid that had been ripping up daisies and selling it back to the neighbor. Like that wasn't really me. But I did know that I needed to go out and explore my life and live it on my terms and not have the confines or the constraints and feeling trapped. I needed to feel free. And so for the next decade of my life, I was a professional rock climber, which sounds really, really cool. I know, but it just meant that I got to sleep in the dirt a lot and climb on rocks all the time, which is pretty awesome.
It does sound pretty cool. You're right.
It does sound pretty cool until you realize like it doesn't make a ton of money. And I didn't think that was a big issue until I tried to marry a woman. I went to her parents. I was like, "Can I marry your daughter?" And they looked me in the eye and they go, "How are you going to provide for our daughter?" And I was like, "Oof, I don't know. That's a good question." So at that moment in my life, I took an assessment of where I was at, what my skills were to try and make money and like to try and provide for this other person. Because up to this point, I'd just been focusing on freedom and living my life, and society hadn't really, put its ideals on me at that point. And so I was like, okay, how do I play the money game? What do I do here? And I started writing. That was my avenue. I had a skill for telling stories. So I decided to start writing science fiction and fantasy novels. And within 4 years, I'd published 12 of those, was doing pretty good. But ultimately that relationship with that woman ended. And I found myself living in the back of a van. She kicked me out of the house and I had nowhere to go. So I just bought a van and I lived in the back of a van and parked it in the back of a climbing gym. And I was really depressed in the sad place in my life where I was writing science fiction and fantasy stories with aliens and robots and all these things that go boom in the back of my van down by the river. And it was just not a good place to be Anthony at that point. And a buddy of mine, he saw me and he's like, "Hey, God, we got to get you out of this. We got to do something." And he's like, "Let's go build a business together." And I was like, "I don't know anything about building businesses, but okay, let's try it." So we used our skills as rock climbers and our network of rock climbing friends to go and build a high-rise window washing company where, we were really good on ropes in high places. And that seemed like a good way to make money. And it turns out it was like a really great business. And that was the bug where the entrepreneur bug finally got me. And from there, I just went on and kept building businesses of like different variety, different types and different industries. And for me, the intersection with real estate came about 8 years ago when I was just looking around me and just was hit with the question, who actually owns all these buildings, right? Like everybody has a relationship with real estate, whether you're a renter, you're a buyer, or like whatever. Like there are all these buildings around you and you probably never stop to wonder who actually owns them. And I hadn't at that point. But once I started asking that question, I realized it's not like really rich people and it's not all institutions. Like, sure, they own some of it, but by and large, like a lot of it's owned by like mom and pops, people that aren't too different than us. And I was like, that's pretty cool. So I started buying small multifamily. Started with a triplex, a house hack, that bad boy, with an FHA loan, and then rolled the proceeds. 9 months later, did a refinance, rolled that into the next thing, and just started scaling larger and larger. And that's what I've been doing for the last 7 or 8 years now.
That is fantastic. I love the story. I think we get to unpack some of that later on towards the end of the episode. We'll see where that one goes. But you're right in the fact that once you kind of got the entrepreneurship bug and you started to realize, wow, I can go buy these little assets that are really little businesses. I mean, they're your customer is your resident, right? And it is an income generating business with expenses you have to pay, just happens to have a hard asset behind it. So you started to see the light there. And I'm assuming also figure out some of the benefits of that as well. But what I'd love to do now that we know that we have a professional rock climber here who also climbed windows for a living, that's pretty neat. I'd love to hear more about that business later. Passive investing made simple. For those of us joining us on YouTube here, right behind him on his, I guess, if I flip the mirror, his left shoulder, not his right shoulder, is Passive Investing Made Simple, one of the number one selling books on Amazon. And you know what, guys and girls, there is not enough material for the passive investor out there. There's a lot of books telling you how to be like Chad Sutton with Quattro Capital and like Anthony Vicino with Invictus Capital, but maybe you don't want to do that. Maybe you make good money. Maybe you love what you do, but you're just like, man, I don't want to put it in the stock market where I'm a number. I don't want to put it in somewhere that I don't matter. I want to put it in something that's going to do good. It's going to help, improve the quality of residents' lives, improve a community. And oh, by the way, I can actually double my money in 3 to 5 years. It's a much better return on your investment with other benefits. So Anthony, there are 3 mega themes that I'd love to get into with this book and how they can really help you not have to have a PhD in this stuff to invest in it. What are those 3 mega themes?
Yeah, I mean, I think most people, when they look at real estate initially, it's very big and overwhelming and scary, and because there's just so much going on there, and that puts people off. And I think if you really want to break it down to its simplest aspect, which at the end of the day, like you nailed it on the head, these buildings are just little businesses. And there's only so many levers that really, truly matter at the end of the day. And if you understand that, then you know enough to be dangerous. And that's the key here, is that most passive investors, they don't want to have the PhD. They just want to know enough that they're not going to make a horrendous mistake. And so the 3 things that you really got to focus on is the operator, the deal, and the market. And it is just that simple. Now, of those 3 things, the absolute most important thing is the operator. Like, who are the people that are actually running the deal? Because the difference between $1 million idea and $1 million is exactly $1 million worth of execution. I can have the best idea in the world. I can't execute on it. It doesn't matter. So the operator is where we got to start. It's the analogy of betting on the jockey, not the horse. And the way that I like to think about this is that, like, the horse is the deal, and the horse is very important, no doubt. But what I've discovered is that championship jockeys don't get on horses that they don't think they can win the championship with. Tom Brady is a great example. Regardless of how you feel about him, he went from one team. He did not go to a team that he just did not think he could win with, right? Like, he went to another team and he won with it. So if you were betting on the jockey there, like, he knew what he was doing, the team that he was going to and why he was doing it, you would have done pretty well. Bring this full circle is like, regardless of how good the deal is, if I give a terrible operator some lemonade, they're just going to spill it on the floor, right? Like, it could be the best deal in the world, and they're just going to waste it. But if I give, a really great operator some lemons, they're going to go make me some delicious lemonade. So, like, you can mitigate so much downside risk by just focusing first and foremost on the operator. Number 2, right behind that then, is the deal is important, and we need to understand enough about it so that we can call out our operators when they're maybe starting to sell themselves on the deal and getting a little bit too high on their own supply. But the thing to know here is that the numbers, they don't lie, but I can make them say whatever I want. So again, if you can't trust me as the operator, then what good are my numbers, right? So the deal is important, but it's still right behind the operator. And then the last bit is the market. And the market's an interesting one because it might be actually the most important one. Like, the analogy I like to think about is, if you have like the 1998 Chicago Bulls and Michael Jordan, like, that's the operator. And then maybe the deal is like, they have the greatest shoes and like the greatest Nikes and the greatest coaching staff and the greatest whatever. It's like, And so they got all the equipment to go out there and succeed. But if the market is that they're playing in the middle of the Sahara Desert, like all bets are off. Right? Like, so the market still matters quite a lot. Now we need to put those three things together: the operator, deal, and market. And if you do that correctly, it's really hard to go wrong.
I love that you just pre-framed every one of those right there, and they are so essential. So here's what we're going to do. We're going to do 4 minutes on each one of those real quick, because 3's not enough and 5's too much. Okay. In Chad's humble opinion, but I really want to unpack real quick for the listener here. How do we pick the right operator? What are some of the traits that you're looking for? Is it personality traits? Is it experience? Where do I start as a newbie investor trying to figure out whether Chad Anthony or Joe Blow is a good operator to invest with?
Yeah, so that's going to come down to a couple of things. One, like obviously integrity is going to be the biggest. If you can't trust the person, then it doesn't matter how skilled they are, how much you like them, like it's all for naught, because at some point, if they lack integrity on one thing, it's just a matter of time before that creeps over into other aspects of their life. Now, integrity is one of the hardest ones to vet, because you can't just ask like, hey, Chad, so you got integrity? You're going to be like, yeah, of course I do. The problem is the way you define it is probably going to be different than I do. And the thing is, like, the bad guy never thinks he's the bad guy in the movie, right? Like, he always has reasons for why he's doing what he's doing. So even when we're starting to tread into the gray areas of our life, like, we're justifying it. That doesn't necessarily mean I want to work with people who are more willing to tread into the gray than not. So integrity is number one. Next is track record. Like, I need to have the belief that you can do what you say you can. And the only way I can really, or the best way I can know that, is if you've done it before. And it doesn't have to be just real estate. You could have been a badass entrepreneur or a badass teacher or like whatever. Like, rock stars are rock stars regardless of what they're doing. Like, they always rise to the top. So that's what we're looking for. Isn't necessarily a track record of success in real estate. We're looking for a track record of success in life. And then finally is we have to have a personality alignment and values, right? Like, where you want to go as an operator, how you invest, your thesis on how the world works and why it works that way. We have to align on that, because this is like a marriage. We're going to be stuck together for 5-7 years, maybe. We're going to need to get along pretty well. Now, communication styles is an interesting one, because I'm not saying you're a bad communicator, but if we always leave a conversation and I'm more confused than when it started, like, then we're not communicating on the same wavelength. That's okay. Like, some people just don't communicate in the same way. And if you're working with an operator where, like, I just don't get it, like, I'm confused all the time, or they seem to speak over my head, like, I just don't click with them, that's okay. Go find the group that you do. Like, those are the things that you really need, is like that personality, that integrity, and that track record. You get those three, and you're going to be good.
Yeah, those are fantastic. And, I think two things that really resonate with me, one of them is the moral alignment, right? The moral and personality alignment. This can be the best person in the world. This can be second to Jesus Christ or whoever you want to compare this person to, a saint, right? But, if this person cares a lot about philanthropy and giving back and things of that sort, and maybe my personality, not saying that it is, but maybe saying my personality is profits, profits, profits. I don't care about anything else. I want to make profits. That's going to really frustrate you 3 to 5 years in, when they're sending story after story about how they've helped a tenant, or a resident improve their financial situation in a way that your investment dollars help. If that's not what makes you tick, that's not what makes you tick. That's what makes me tick. So that was a great example for me of where I've been in misalignment with operators who don't do that kind of stuff. But, this can be a great operator, but if their morals don't align with your morals, whatever they are, it's going to be a long 5 to 7 years. What do you think about that?
100%. 100%. I think there's no value judgment here of saying, like, your way is better than my way, or you're wrong and I'm right. Like, it's not about that. It's about finding the people that are trying to row the boat to the same place that you're trying to get to. And that's fine. Like, maybe you're going to that island over there and we're trying to go over here to this island. Neither island's right or wrong. Just understand, which boat do you want to get into?
That's right. That's right. And talk about track record just a little bit in our last 30 seconds on this topic. So, with track record, you said it doesn't just have to be real estate. So why is that? Why do we think that someone who hasn't done a real estate deal before, but has succeeded elsewhere, can make lemon out of lemonades, as you put it?
So I will say this is that first, I personally don't like, I wouldn't invest with a brand new operator who's never done a real estate deal before. I believe that you need to pay your tuition at the School of Hard Knocks with your own money first before you start taking other people's money, because it is
100%. By the way, I agree with that.
It's a sacred responsibility that you have when somebody gives you their money. Like, it's not just money. It is something that they exchanged a portion of their life for. They're never going to get that life back. They had to make decisions that took them away from their family, their friends, and other things that they could have done with their time to go make that money. And so if you can't look them in the eyes and say, I can do right by this, then don't take their money. And you can't really do that until you've done it before, at least a couple of times. So now with that said, like, I don't want to poo-poo and say, okay, this person's a capital raiser for that operator over there, and that operator has a ton of operational expertise, whereas the capital raiser maybe doesn't. Like, okay, I can make a justification there. I can work around these ideas. But at the end of the day, like, I think if you really want to invest well, like, invest with people who've done the thing and they've done it on their dime first, because that is the ultimate test of skin in the game and ability, is that they walked across the coals themselves and didn't just watch or read a book about walking across the coals.
That's a mic drop moment. So folks, number one, pick the right operator. Number two, pick the right deal. Okay. Why is the deal important?
I mean, the deal is the deal, right? Like,
it's the horse.
And deals are like in far shorter supply than they are capital these days. I think that's something a lot of people are overlooking, is the fact that deals are not growing on trees. There's more capital looking for a home out there than there are great investment opportunities. And what ends up happening is people will start taking on marginal deals because they got to put their money somewhere. But that's not a good investment thesis long term. Like, so we got to be stringent in what we're looking for. And what I'm always looking for is risk mitigation. First and foremost, you take care of the downside and the upside will take care of itself. Basic premise of investing in general is that if we're just seeking above average returns, well, we can do that by taking above average risk, right? I don't want to do that. I don't want to take on more risk, but I do want good returns. And so when it comes to evaluating the quality of a deal, generally the number of levers that you as a passive investor realistically need to know and understand and take a look at are very few. I would maybe even boil it down to like 4, maybe 5. You have cap rate assumptions, especially reversion cap rate. So like, what is the cap rate when we're going to dispose of this property? That's a huge one. What is that in relation to the acquisition cap rate? That's going to tell you a lot right there. Others are like rent growth versus expense growth. How optimistic are we being with our organic rent growth and our organic expense growth, especially in an inflationary market where we are right now, where like those things are crazy, right? So we got to stay on top of that. And then really understanding expense ratios. One of the most valuable business lessons I ever had from a mentor was to remember that a dollar saved is worth more than a dollar earned, because the dollar saved goes straight to the bottom line, whereas a dollar earned is almost always on a margin, right? So if we're operating a business with a 50% margin, then $1 of revenue is only 50 cents to our NOI. So we want to focus on expenses, but the problem is, to reduce expenses requires operational skill. So it's not enough for me just to say we're going to cut expenses by 10% down to 40% for an expense ratio. You got to have actual plan and ability to go execute that. So I think those are the numbers. You look at those and you get a sense for how conservative or aggressive the operator is, and you have a pretty good idea of how solid this deal is and what the likelihood it's going to perform regardless of what the market cycle does.
Let's unpack those one at a time, because this is gold right here, folks. So the reversion cap rate, and reversion is a fancy name for sale. Okay. When you sell the property or refinance the property, but the point is, you buy the property at a certain cap rate that is, the current net operating income divided by the purchase price. Let's say that is in this market, a 6.5, I think is a pretty good cap rate. Let's say you get a 6.5 on it. So we think it's a pretty good deal going in. Well, then you go down to the bottom and you say, wow, he's going to send me a 30% annualized return when we're done. This is great. I'm happy. This looks great. How can I sign up? But you don't go down and look at the underwriting model and see that, wow, this guy's pretty bullish and he's underwritten this at a 3 reversion cap rate. Well, of course your return looks great, because he's showing a huge bucket of natural appreciation, right? I mean, all of these deals, when you talk about assembling a return, you want to mix the forced depreciation, which is like the operational stuff you're going to do, the renovations, the reduction in expenses, anything you're going to do to market the property better, all that operational stuff to make the net operating income grow. That's your forced depreciation. And as Anthony will talk about in a minute with the markets, I'm sure, we want to do this in markets that are increasing. So you'd like to see a cap rate, going down over time, but you really have to be careful that all of your return isn't showing up from the cap rate. I mean, how often do you see that? Is that a common trick to make things look good, Anthony?
I think so. I think it's far more prevalent than people even realize, because I think there's a lot of confusion about how you even define cap rate at acquisition. Are we talking about like the going in cap rate of how the property is currently performing? Are we talking about how you're going to perform after 1 year once it's stabilized? Like, these are very, very different numbers, and they can skew things quite drastically. And sometimes in an attempt to show like, oh, we're going in at a better cap rate, like to show that, oh, we got a really good deal, people will like start jimmy rigging things in weird ways. And as a general rule, I say you need to be very, very bearish on all assumptions that you are not in control of. And you should also be bearish on things that you can control, but really large macroeconomic things. And that's what cap rate is really going to be defined by at the end of the day, is things that you have zero control over. So you are better off assuming that it is going to go against you rather than assuming it's going to go for you. It's like, listen, our ancestors got us to this point in the history of Earth because they assumed that there was a tiger in the grass. And so they ran at the first sound, right? They didn't just sit around waiting to say like, I don't think that's a tiger. Like, the optimist died, the pessimist lived, right? So we come from pessimistic genes. Problem is these days, like, I don't know, there's not too many existential crises in the grand scheme of things. The number of things that can kill you out on the street, very, very low. So we can afford to be more optimistic in modern society than our ancestors could. But when it comes to investing, optimism is a terrible investment strategy. Like, we should always err on the side of assuming cap rate is going to go against us. It's going to soften over time. And if the deal still performs, then awesome. You have a really strong deal, because if that does happen, if the cap rate does soften, well, we've already prepared for that. In the case where you're saying the cap rate's going to go from 6.5 to a 3, or even 6.5 to a 6, so many things have to go right that you have no control over. So I don't know. Hope is a terrible investment strategy in general.
It really is. And the way that Quattro Capital presents this stuff, and I'm sure Invictus and others do it this way as well, we're not unique in this. We don't pretend to understand your risk profile, right? So I'm going to show you what happens if the cap rate gets worse by 100 basis points, gets worse by so if we're at a 6%, it goes to a 7% when we sell. Are we still making money? Okay, if the answer is yes, what happens if it stays flat? And then what happens if it gets better? There are optimists out there who want to see it, so I'll show it to them. But I'm gonna preface that with a lot of things have to go right to get here. So you get a range. You get to kind of bound your problem and see how good or how bad you want to assume here. But one thing that I'm curious to hear your thoughts on this, we talked about expenses, about how, being able to save $1 in expenses is 1-to-1 on your profits, right? And then of course you capitalize that, so it becomes greater than that by a lot. And as long as there's a tangible business plan for, you can't just go in and say you're going to cut payroll in half and maintain the same operations. You have to actually show how that's going to happen, right? You have to show how you can still control the property with one person on site, But what about income? I mean, one thing that I see a lot of operators doing incorrectly is, I call it revenue recognition, right? They are saying, okay, well, I'm going to go renovate this property from, let's say, $700 in rent to $900 in rent by doing a $7,000 renovation. Just for some round numbers here, $200 rent increase. I've seen pro formas that by the end, my year one rents literally say, if I do the math on it, it is number of units times $200 rent bump times 12 months, which means they're assuming they have already done all the work and they have it all in place in the first year, which is going to be a gross underrepresentation when you actually start realizing how long it takes to step through with units moving out. I mean, how often do you see that? Is that a concern of yours?
I saw this actually pretty recently. I coach a lot of students on multifamily investing. And so I get to look at like new underwriting. And this is one of the most common things people overlook, which is they forget when you're underwriting, we underwrite for year 1, year 2, year 3, but we forget that there's 365 days in that period of time. And that's not all just happening at day 1. A lot of it's happening at day 50 and then day 273 and day 312. And most underwriting models are not sophisticated enough to show you like what happens at those different gradation points if we do the unit turn in month 3 versus month 9. And it's more of an intellectual exercise of sitting down and realizing, okay, can you get these rent bumps? Sure. Can you logistically do all those unit turns? in a week, or let's say like whatever your time frame is that you're laying out there, like, can you logistically do that? Can you get all the supplies? Can you get all the labor? Can it actually get done on that schedule? And if you just sit down and start thinking about that stuff, it starts to like expose itself as a weak narrative. And so in the book, what I talk about is like numbers can obfuscate, or that's another way of saying like confuse or conceal. Like the numbers can conceal how strange the business plan really is. But when we put it into a story, the human brain like starts to unpack it in a much different way, because we're evolved to understand stories. That's just how we communicate. So if I tell you like, hey, we're buying this 250 unit complex and we need to go and renovate 100 of those units, and we're going to get a 200 unit rent increase, and we're going to do that on the first month, and then by end of first quarter, we're going to start cash flowing. As I start telling you that story, your pothole alarm starts going off, and you're like, wait a minute, wait, so you're going to do 125 unit turns in like the first month? Like, are there tenants in there? Are there leases all running up at that same moment? Like, who do you have for a construction team that's going to go and turn 125 units? And then how are you going to instantaneously get tenants into there? Do you already have a backlog of tenants who are ready to move in and put down security deposits? Like, once you start unpacking that, you're like, oh, this business plan is flawed.
Yeah. And likely that's not the case. It's possible that they have that set up, but they should be able to tell you that narrative and prove it to you, right?
Exactly.
Likely that you're likely not going to see to where in month one, 125 units are turned and then it's ready to go rented up by month two. That is just, wow, logistically, it would be a spectacle if we could see that.
Yeah. And honestly, like even if you pare that down, by down to 30 units in a month, that's still what, we're vertically integrated. So we have a property management and construction company in-house. So we do this stuff. And so like we maybe have a different sense of like how hard it is to turn units like quickly and efficiently. Like it's hard. And once you start adding in like the complexity of doing dozens and dozens of unit turns simultaneously, the complexity only goes up and the likelihood of running over budget and overtime only increases.
I really encourage everyone to go get this book, because the chapters on this subject are going to educate you so much. We could spend 3 podcasts or more talking about just things to watch out for in this area. Again, you don't have to have a PhD. You just have to use common sense and know a couple of key things. Like, what are the key levers? What are the key levers that make the dial move, right? Once you have that, you're good, So I apologize. We went way over our 4 minutes there, but it was worth it. It was really good stuff here. So the last one is the market. We've now been through the operator. You can't see my hand. What happened? The operator, you have the deal, and now we have the market. So Anthony, tell us why the market is so important.
Well, it's all about like the winds at your back. Is the wind at your back, or is it in your face? And if you're on a sailboat, that makes a big difference of where you're trying to get to. So first is like, why go into the wind? Why make it harder on yourself by going to a market that has a declining population, maybe has really difficult tenant landlord regulations, like just doesn't macroeconomically have a strong outlook? Like, why go invest right now, or let's say in the early 2000s, why go invest in Detroit when you could be investing in a market that has strong growth, that has strong job growth, has strong population growth? We look at like median income versus cost of living. So we try and figure out what the affordability index is, and that we always want to have a strong one, because the stronger the affordability index, it means more disposable income people have, which means they have more that they can spend. Generally, that means a stronger market. So like, why make it more difficult on yourself? Like, sure, you can go find a deal in Detroit in the late 2000s. You could, but why make it harder on yourself? So like, let's try and line up as many of the macro factors that are largely outside of our control, and make sure they're at least at this moment and for the foreseeable future, not willfully going against us.
I love what you said there, because folks, I can go to Los Angeles, California today, and I can go find a property that is older, needs renovation, and probably has $300 or $400 of rent bump available if I go do those renovations and spend the money, right? But if you look at it, I'm fighting headwinds of rent control. I'm fighting headwinds of a lot of people who have already bid those prices way, way up, and the cap rates are low. So buying something at the right price is going to be hard. I'm looking at really high labor rates and really high cost of supply. So my renovation is probably going to cost $15,000 plus to do that, right, per unit. And oh, by the way, there's just not that much attractive nature as an investment market. So when I go to sell this thing, I'm going to have a hard time turning it over and making the profit I'm looking for. Whereas I can walk to the other side of the country, and go invest in somewhere like Tennessee, which you see Nashville all over the news all the time. I'm not saying go there, but that's an example of a great market that's made the news in the last decade of this cycle of, jobs are coming in, population's coming in, the business environment is profitable and good for attracting jobs in. So you can go there and actually see the right balance of supply and demand, and actually see prices continue to rise organically if you did nothing. Now then you go couple your something that you're going to do, and that's when you really get that. But what's the analogy, Anthony? When you have one speaker and one speaker separate, they sound like one speaker, but you face them together and they sound like three. That's what putting forced appreciation and natural appreciation together will do for you.
Yeah, generally when it comes to business and investing, like you want to make it, there are so many things that can go wrong. Like investing is inherently risky, and we know that 80% of businesses don't survive their first 5 years, right? So it's tough. So why make it any harder on yourself? At least line up like the opportunity in an advantageous way. So like Tennessee is a great example where we know that there's strong macroeconomic tailwinds behind it. So if you put your boat in that water, it becomes really hard to not do well, right? Like, and I'm not saying like LA is bad in the sense that you couldn't make money there. You could, it's going to be harder. I would want to see a lot of operational expertise and local expertise of like, what are you doing? Do you have a track record in this market? Why are you choosing to make it harder on yourself? It's like, maybe the operators make it harder on themselves because that is their unique edge, which is they're local to LA and they have like a dominant edge there. Okay, I can get behind that. Yeah. But like generally, I think most people end up going to bad markets, not because they have a situational expertise, but just because it's convenient. And when you really look at it as a passive investor, there's no reason to do that because all markets are equally convenient for you because you don't have to go to the property and manage them. So take your time and find the ones that are, positioned to do the best.
Couldn't agree more, Anthony. So folks, go to Amazon. There will be a link in the show notes. Scroll down, click it. Passive Investing Made Simple by Anthony Vicino. You will really gain a lot from reading this book. If you found this at all helpful, feel free to go find his podcast that was mentioned in the intro as well. And will also be linked in the show notes to hear more of what Anthony has to say. Like, subscribe, all that good stuff. So Anthony, before you get off my show, you get to go through the Quattro Trio, a list of questions here that are really aligned to the 4 pillars of Quattro. That is people, property, profits, and philanthropy, most of all. Okay. Mm-hmm. So let's jump into you as a person here. What is your superpower as it relates to your business?
The one that I always talk about is hyperfocus. And that's not just like the ability to focus, but like hyperfocus. No. So I mentioned at the beginning, I have ADHD, which is attention deficit hyperactivity disorder. And most people think that means we can't focus, but what it means in reality is that we can't control always what we're focused on. When we are focused, when we're really interested in something, we go into what's known as the hyperfocus state, which is the kissing cousin of the flow state. And when you're in that state, like this is why people with ADHD will play video games in a burning down house and not even notice. Like if you can harness that, which it took me a really long time in my life to figure out how to actually turn this from a weakness into a strength. Once I did, it allowed me to go so much deeper in everything that I do. So that's definitely the strength.
Very interesting. I didn't know that about you. That's a really, really interesting quality. All right. We've heard a lot about how you're awesome, Anthony, but give me some dirt, man. What is your biggest failure to date and what did it teach you?
I mean, there's so many. I think when we talk about one of the biggest mistakes that I made was falsely thinking that there's this dichotomy between the science of achievement and the art of fulfillment, right? And for much of my life, I equated achievement in the striving towards a goal, winning this medal, doing that thing, winning that competition, building this business, making that much money, that as somehow it would, if I did it enough, it would make me feel complete, make me feel full. Because fulfillment at its core means that we're not fulfilled, like there's a hole in us. But when we try to fill that hole with achievement, what we're really doing is we're taking 2 separate mediums and trying to combine them. It's like if the road, if that's fulfillment, is made of asphalt, then we have a pothole and we're trying to fill it with achievement, which is like spaghetti noodles. Now we just have spaghetti noodles in a pothole and you're not full. And for so much of my life, I spent a lot of time and energy not focusing on the people and the relationships around me that would make me feel fulfilled. And I was focusing more on the achievement and winning and trying to be the best, not recognizing that I was never going to fill that hole inside of me with that medium. So that's definitely the biggest fail here.
That's a great one to note. Thank you for that, Anthony. All right. And we've talked about your book. So let's move on to the philanthropic cause portion. One of Quattro's biggest pillars of our four is giving back to this world. What philanthropy can our listeners like and promote on your behalf?
So I don't know about you guys, but for so much of my life, money was a very, very stressful thing. Finances and the idea of investing was just like really overwhelming. And I didn't grow up in a family that spent a lot of time talking about money. And I don't remember there being a class in high school where we talked about it. And so I think most of us, I think a lot of people relate to just how scary it is, and feeling like everybody else knows something that you don't know, and you feel stupid to ask. And it's interesting because we simultaneously as a society put people who have money up on a pedestal, but then we also have this taboo against talking about it and feeling like an idiot with our friends and families. And nobody talks about, like, what are you investing in? What's your net worth? Like, how are you managing your wealth? And so we all feel isolated and alone. So what we do is we've partnered with a program here in the Twin Cities called Project Success, where they go into all the schools, all the high schools and middle schools in the Twin Cities. And they teach financial literacy in a way that actually connects and helps people, the kids that need that, so that they are equipped with understanding the rules of the game. Because the money game, what I later discovered is that it's really not complicated. It's very simple once you understand the rules. The problem is that most people just don't even know what those rules are, and they're too scared to even ask. So we're pretty involved with that program in terms of helping at a very young age. So kids coming out of school, maybe they don't use the information, in the early 20s, because when we're young, we're dumb. But at some point in their life, they're going to say, how do I win this money game? How do I play it better? And hopefully they'll have that knowledge and that experience to pull on from when they were young and say, this is how I do it.
I couldn't get behind that enough, folks. Project Success is what that's called.
It is. Yep.
That's fantastic. So we'll get a link for that and put it in the show notes as well, so you can go support that on behalf of Anthony and Invictus Capital. But what a great cause. I mean, for one thing, kids are dealt the hand that they're dealt. I kind of have this feeling that adults, they make their bed and they sleep in it, right? But the same way I support the children's hospital my wife works for, this is, the kids have to play the cards that they're dealt, And if you can at least give them a couple of aces, that they may not pull them out of their pocket for a little while, but if you can at least give them those aces and just help them understand what the rules are, there's an abundance of wealth out there, folks. This is not one of those zero-sum games where, especially in real estate, it's not a zero-sum game where for me to win, you have to lose. We can all win at this. And, the more of our society that starts to wake up and figure out that your wealth is in your control, and it's actually not that hard to get there if you just apply a few simple rules, our entire society will be more abundant. There'll be more giving. There'll be more helping. So I can't get behind that enough, Anthony. Thank you for sharing that one.
Yeah, I think one of the most core concepts that I think if everybody, adults or children, could just understand is that I think most people think that you're paid by taking value. Like, you're taking value from somebody else or from this thing. Like, when I take profits, I'm taking that value. And that's not what you're being compensated for. That's not what you're making money for. What you're making money for is by creating value. And creation is not a zero-sum game. It's infinite. And there's nothing stopping you from just going and creating that value. Figure out where your unique skills and your unique genius can bring value to the world, and you will be compensated as a result.
Folks, I'm pretty greedy with the mic drop moments on this episode, on the show, but I'm going to give this one to Anthony today. He's got it. That is the mic drop moment for the show. We're going to end it right there. Anthony, what is the best way for people to get in touch with you?
Yeah, if you want to learn about what we do on the investment side, check us out at invictusmultifamily.com. And you already, put out the book, so I really appreciate that. Go pick up a copy. Would love to, have a conversation with anybody that's just interested in learning more and becoming a little bit better as an investor, whether they invest with us or not. Like, I don't care. I just want you to know that this is a vehicle available to you. And if you want to be connected to other operators that are doing fantastic work, we can do that. We can help you out.
Fantastic. It's a really small world here. I know I'm glad to have added Anthony and his team to my Rolodex as well, because I feel the same way. We're not the best fit for everybody, but we usually know someone who is. So good stuff. All right, everyone. We are grossly over time, but it was worth it. You just can't stop talking to someone like this. This has been another episode of the Real Estate Runway Podcast. Until next time, over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway Podcast.